Is it visible now?
Yes, Dhanashri.
Perfect. We can start, is it? We'll just wait for maybe 5 more minutes and then start.
Dhanashri?
Yes, Venu.
Yeah, can you share the screen?
Yeah. We can start like.
Yeah. Start.
Good morning, everybody. Today's topic is GST implication on corporate guarantee with related party. So this has been a topic I think we have discussed a couple of times. Jatin sir has thrown light on some of the aspects of on whether corporate guarantee is a service or not. And from what I recall, from what Jatin sir was also mentioning and the other mentors were also mentioning, that corporate guarantee is a service, is what we were discussing then. But how about corporate guarantee with related party? What happens there and how does it play out in GST is what we're going to be discussing a little bit more in detail. I would like to put a disclaimer here that my practical experience in this space is very minimal. So I would invite a lot more interaction so that we understand the topic more in depth. Yeah. Yeah. So what is this corporate guarantee? It's generally a pledge made by one company, that is the guarantor, to another company, of another company, that is the debtor, to a bank or a financial institution. That's generally what is corporate guarantee. From the borrower's perspective, the guarantee may affect the terms of borrowing, such as favorable interest, favorable amount of loan, etc. And the person who is the guarantor to the bank or the financial institution is usually, the bank usually charges a fee or a commission. And usually the person who is providing the guarantee cross charges it to the person who the guarantee is provided for, that is the debtor. That is how it usually plays out in normal parlance. But in case of related party, in many situations, there may not be a consideration, and that's where whether corporate guarantee is a service becomes more questionable. So I would like to touch upon a little bit about transfer pricing aspects. whether corporate guarantee is an international transaction at all. So the definition of international transaction under Section 92B of Income Tax Act includes capital financing, including any type of long-term, short-term borrowing, lending, or guarantee. So basically, guarantee is specifically included in the definition of international transaction since from the time the Finance Act 2012 has come in, but it's come in from retrospective effect, that is April 2002. That's since when the international transaction definition has come into picture. The Finance Act has said guarantee is a part of international transaction. What is the argument is that where guarantee does not have a bearing on profit, income, or losses or assets of an enterprise, it should be taken out of the purview of the very definition of international transaction. That's the argument under the income tax law, saying it does not form a part of the international transaction definition because it does not have any bearing on profit, income, loss, asset of the enterprise who is the borrower, or who is the guarantor in this case. So usually this plays out in a scenario where an Indian company is providing the guarantee to a foreign company. An Indian holding company gives guarantee to the foreign company or associated enterprise. And there is generally in such a case no consideration. And what happens then in income tax? So the question that arises is whether it is a shareholder activity. So the OECD guidelines define shareholder activity to mean an activity which is performed by a member of a multinational enterprise group, usually a parent company or a regional holding company, solely because of its ownership interest in one or more other groups. That is, as a capacity as a shareholder. So whatever the activities performed by a shareholder is called a shareholder activity. Generally, the taxpayers argue that it's a shareholder activity. That is, it is not done for a commercial purpose. It's just done so that my interests in the company are safeguarded as a shareholder. However, many courts have held that where the purpose of loan is for acquisition for another group company, then the guarantee provided on such loan may be considered as a shareholder activity. However, where loan is taken for commercial purposes, then the guarantee on such loan is not a shareholder activity. And this is also elaborated by Madras High Court in Reddington's case, which we will go through a little bit more in detail in the forthcoming slides. Then there are multiple types of corporate guarantee. One is implicit, explicit, letter of comfort. So whether letter of comfort is a corporate guarantee at all is also a question. There are cases where parent company only provides letter of comfort to the bankers saying, yeah, I'm there. Like, don't worry about it. You can give loan to this subsidiary of mine. So many courts have held that letter of comfort, unlike an explicit guarantee, is not a written document that is legally enforceable and therefore cannot be considered as a provision of guarantee. On the other hand, wherever there is an explicit guarantee, that is, the documents specify that this is an explicit guarantee for the purpose of this loan and all of that, and this is the value of the guarantee, or this much amount, for this much amount we are providing a guarantee, etc. That becomes an explicit guarantee. That is a legally enforceable document which imposes a liability on the guarantor in case of default by the borrower. So the guarantee creates an inherent risk on the guarantor, thereby demonstrating that it is liable to a guarantee commission. So that is where the guarantee becomes a service, because the guarantor assumes a risk when in case there is a default in the loan. So what the Reddington decision says in terms of the corporate guarantee, whether it is an international transaction, is it talks about two major principles. One is the amendment made in 2012. It is made with the object of removal of doubts and to clarify, and that's why it should be read as retrospective. The second thing it says is the provision of corporate guarantee always involves inherent risk. And there is a service provided to the associated enterprise to increase its credit worthiness to obtain loans in the market. Although there may be no immediate charge in the profit, loss, asset, etc., the inherent risk cannot be ruled out in connection with the guarantee. And that is where it becomes a service, and that is where it becomes an international transaction, is what the Madras High Court has spoken of in Reddington's case. So once this ruling came in, I have not seen a counter ruling to this, counter judgment to this. And though there is still an argument under the income tax law, whether this forms part of the international transaction, whether there is a risk that is assumed by the parent company, etc. Whenever the notices come in, usually the valuation is done, and usually the taxpayers are going ahead and showing it as a part of international transaction for the purpose of valuation. However, practically what is happening is when there is no notice, most of the enterprises are just not showing this as part of international transaction because of the argument that it is not having a bearing on profit, loss, asset, etc. So what is the risk and why corporate guarantees can be, categorized under services? So corporate guarantees can impact the allocation of risk within the group. When the parent provides guarantee to a subsidiary, it assumes some or all of the risks. And tax authorities, when they scrutinize whether the pricing reflects the actual assumption of the risk by the guarantor, particularly if the guarantee provides a financial benefit to one party over the other. So that's what the tax authorities assume, whether there is a risk that the guarantor is assuming. While corporate guarantees can be a legitimate business practice for managing risk within a multinational group, tax authorities scrutinize the arrangements that appear to be primarily motivated by tax avoidance rather than genuine business reasons. And that is where the multinational corporations must be able to demonstrate that their transfer pricing policies, including those related to corporate guarantees, are driven by commercial considerations rather than minimizing strategies. So under transfer pricing, usually whatever the banks charge a percentage of the guaranteed amount as a commission, like I already said, and which is usually cross-charged to the borrower. However, where that is not done, or where that is not done in a arm's length pricing method, the safe harbor rules provide for commission of 1% per annum of the guaranteed amount. And from what I have done, from the research that I've done, looks like GST has also relied on these safe harbor rules, which are based on certain practical assumptions. Usually the corporate guarantee commission is assumed to be 0.5% to 1% of the guarantee amount. And that's where the safe harbor rules have taken that 1% from. So having said that, this is what is happening in the income tax law, and we have a not favorable ruling in terms of the Madras High Court saying that there is a risk that the guarantor assumes. What happens in the GST context? How was it under the service tax era? So under the service tax era, the negative list especially spoke of service to be activity by one person to another person for a consideration. The meaning of consideration was not defined under the service tax law. It was taken from the Contract Act. So the Contract Act defined the term consideration to be when at the desire of the promisor, the promisee or any other person has done or abstained from doing, or does or abstains from doing, or promises to do or abstains from doing something, such act or abstinence or promise is called a consideration for the promise. So the Contract Act is just talking about consideration in terms of quid pro quo. It's not saying it has to be monetary terms, which is where our GST law is saying that consideration is payment, etc. That's how the definition for consideration starts in GST law. So under the service tax law, consideration could have been cash, consideration could have been cash or kind. It just needs to satisfy the quid pro quo between the two parties. So what happened in Edelweiss financial services case was that there was a guarantee between the related party and there was no specific monetary consideration. So the court ruled that since there is no, so the Supreme Court ruled that since there is no consideration in monetary terms, there is no service and not liable to service tax. The discussion did not go into the aspect of whether there is a quid pro quo, whether the consideration can be assumed to be in kind, etc. There was no such discussion in the Edelweiss Financial Services Limited ruling. So the concept that came in, or the ruling, the judgment that came in the service tax era was, since there is no consideration, this is not a service, and since this is not a service, this is not liable to service taxes. That is what the court ruled, is what I understand. We could discuss if there are other thoughts here in terms of what Edelweiss tried to communicate. So under GST, this consideration has been defined to be, like I said, payment in monetary terms. So in most cases, it is money or money's worth, which is what GST law speaks about. However, the Schedule 1 says transaction between related parties, even when there is no consideration, is liable to tax. That's where the GST law is different from the service tax law, which says that wherever there are related parties involved and there is a transaction, whether or not there is a consideration, it would become liable to tax whenever there is a supply. The supply would still be validated. Although the definition of supply says that there has to be a sale, etc., between one party to another party for a consideration. So Schedule 1 is an exception to the general principle of supply. So Rule 28 has always been there, which says the value of supply of goods or services between distinct persons shall be open market value. If open market value is not available, the value shall be the supply of goods of like services, supply of goods or services of like kind of quality. And where that is not possible, go to Rule 30 or 31. The proviso says that where the recipient is eligible for full credit, the value declared in the invoice shall be deemed to be the open market value of the goods or services. So this rule has always been there since the time GST has come in. This has been there. And our circular 199 and circular 210 have further said that wherever there are related parties and full input tax credit is eligible, the invoice value shall be considered as open market value. And if there is no invoice value, it shall be deemed to be nil. If there is no invoice issued, the invoice value shall be deemed to be nil. So basically, the overarching point that the circular 199 and 210 is trying to make, and this provisor is trying to make, is that wherever the full input tax credit is eligible, invoice value can be whatever. It can be a nominal value or it can even be zero. However, the problem is when full input tax credit is not eligible, that's when the valuation needs to be made. So Rule 28 did not specifically speak about corporate guarantee, but it spoke about transaction between related party. And I would say if not for Rule 28(2), it could fall under Clause B, Clause A and Clause B, where open market value is not available. The value of supply of goods or service of like kind and quality would be the value of a particular service. Notification 52 and Notification 12 have introduced Sub-Rule 2 to Rule 28, which spoke of notwithstanding anything contained in Subrule 1, the value of supply of services by a supplier to a recipient who is a related person located in India by way of providing corporate guarantee to any banking company or financial institution on behalf of the said recipient shall be deemed to be 1% of the amount of such guarantee offered per annum or the actual consideration, whichever is higher. Again, the proviso is the same as proviso to Subrule 1, provided that where the recipient is eligible for full input tax credit, the value declared in the invoice shall be deemed to be the value of the supply of service. So let me reread this and let us break this down. The value of supply of service by a supplier to recipient. The recipient and the supplier, if they're related persons, and the recipient is located in India by way of providing corporate guarantee. And the corporate guarantee should be to a banking company or financial institution on behalf of the said recipient. Then the value of the corporate guarantee shall be deemed to be 1% of the amount per annum. So per annum has been added by notification 12, and the proviso also has been added by notification 12. Before that, the notification 52 did not have the proviso, which is where there was a lot of question in the industry saying what is really going on. Why is this new provision just come into place? So here, if we see, it is the recipient has to be in India. So it is basically only for transactions which are happening within India, where the usually the holding company or the parent company should be in India, and the subsidiary also should be in India, is what this is saying. If that is not the case, it could become an export and may not come under this. So Circular 204 talks about where guarantee is by individuals like promoters, directors, other managerial personnel or shareholders. The consideration, there is no consideration. In fact, RBI mandates that there should not be any consideration. And because of that, there is the open market value would become zero in such a case. And it is only in cases where there is a corporate guarantee between a holding and subsidiary company or between two corporates. That is when the Rule 2 of Subrule 2 of Rule 28 would come into picture, is what this Circular 204 is trying to clarify. It also says that, however, despite RBI's mandate, where the director, promoter, etc., are not a part of the, like, let's say the director or the promoter moves out of being a director or promoter for the company, and there is a specific consideration given by the company to the director, etc., for providing the guarantee, then that would become the actual consideration would become the value of the service provided by the directors, etc., to the corporate. So Circular 225 talks about clarifying Rule 28.2. It says that Rule 28.2 applies only to determining the value of the taxable supply and not the taxability. It says taxability has always been there since the time GST has come into picture, wherever there is a transaction between a related party. The value of supply is based on the guaranteed amount and not the actual loan disbursement. Let's say I am going in for a loan of 10 crores, and the value and the guarantee is for the 10 crores. However, the loan is disbursed for, let's say, 1 crore or 2 crore, and it's still in the process. And let's say the loan for 5 crores is disbursed and balance 5 crores is not disbursed at all. But the guarantee is for 10 crores, then the value will be for the guarantee and not the actual loan disbursed. The recipient is eligible for input tax credit immediately as soon as the recipient pays the tax in this case. The value of corporate guarantee is only to the services provided by the corporates to the guarantor to the debtor, only to the amounts borrowed from banks or financial institutions. It is higher of 1% of the guarantee amount per month, per annum, or the actual consideration, whichever is higher. And if the guarantee is spread over multiple years, the value would be 1% of the guarantee amount multiplied by multiple years. And for periods less than 1 year, the value is proportionate to the duration. So whatever research I've done practically also this is what happens. If the bank takes guarantee, if the guarantor is providing the guarantee to the bank for, let's say, 5 years, the bank would charge fees for those 5 years, and that is what would be the value of the guarantee. So that is what has been spelt in the circular and in the rule is my view. The issue, however, comes in where it says that where the bank is genuinely providing a value for the guarantee, it says that if 1% is higher than what the bank is providing, then 1% would be the value of the guarantee for the purpose of the determination of what the service is. That's what the circular says. Possibly that, in my view, could be an issue. The issue also comes in where the recipient is not eligible for credit, and genuinely there is no consideration. Then this valuation brings in that provision, and it says 1% of the guarantee becomes the value and tax needs to be paid. That is where the provision becomes a little bit of a coercive provision. But otherwise, wherever there is the recipient is eligible for the credits, this 1% does not mean anything actually. It can be any nominal value that can be put on the invoice, or whatever is the actual consideration can be put on the can be raised for the tax can be collected on that particular value. So yeah, now I'm done with my presentation as such. We can discuss if there are any thoughts, issues, etc. And if any of my thoughts are controversial, or if you feel that they're not in line with the industry practice, I'm open to discussion, because this is all theoretical knowledge that I've gained and my opinion that I have expressed, but I'm open to listening to what the practical challenges could be and what are the other points that I have failed to understand.
Dhanashree, there are some points which I have put in the chat.
Okay.
So before we look up others, maybe
Okay.
you can take up.
Yeah, Rule 28(2) is applicable only when the recipient is in India. If the recipient is outside India, what should be the valuation? It would, I'll just again look at Rule 28 and we will look at the proviso. The value of supply of service by a supplier to a recipient who is related person located in India. So if a person from outside of India is providing the corporate guarantee to a recipient in India, Rule 28 would come into picture. I do agree that, but I am again looking at whether it is talking about the value of supply of service by supplier to a recipient who is located in India. Is it the located in India? Would it apply to a supplier and or a recipient, or would it apply to a recipient is something that we can discuss. But I would say if not Rule 28.2, Rule 28 would apply, wherein the value would be open market value, and the open market value would still be 1% is my view, or whatever is the like service. And that is where the value would become determinative.
See,
Insertion.
if it is okay, my view is if the recipient is outside India, it would be kind of export of services, zero
Sorry,
rated
I
supply.
read it as recipient in India. For some reason, I thought the supplier is outside of India. But yes, if it is recipient is outside of India, it would become export. Correct.
Yeah, it
That's
would
something
be
I had mentioned
exported.
actually. Yeah.
Yeah, it would be exported.
Yes.
And there cannot be a deemed valuation made mandatory for an export when there is no export. So to avoid treating something as an export when there is no export, and it creates an issue with the income tax provisions, maybe a view of mine that, okay, it's a choice of the supplier to levy or not. Because if it is not levied and deemed as valued, the income tax and other issues would be cropping up. So hence, they would have brought it as a trade-friendly measure, is my view.
They would have brought it as a trade-friendly measure, is it? As in, can you please elaborate a bit?
See, if there is a recipient who is outside India and I have not charged the GST. Now, by virtue of this, if I have to mandatorily make a notional entry, I am pushing the taxpayer to treat it as export and claim zero rated benefits under GST, which is could be a detrimental for refund and other things. Second, I am also pushing him that, okay, we are declaring a value. So for the purpose of income tax, there's an increase in the value, and the taxability will come up an issue.
I think our circular 225 talks about what if it is an export. I'm just pulling that out.
Register anything in this?
So clause 8 of circular 225, like the question number 8 talks about whether the valuation in terms of 28.2 of CGST rules will apply to export of service of providing corporate guarantee between related person. So as per amendment done in Rule 28.2 of CGST rules, retrospectively with effect from 26th October, the provisions of the said sub-rule will not apply in cases where the recipient of service of providing corporate guarantee between the related person is located outside India. Accordingly, the provisions of the said sub-rule will not apply to export of services providing corporate guarantee between related persons. So the circular is clarifying that wherever there is export, this provision doesn't apply. But yeah, I would like to listen to the views of everybody and mentors saying what it could mean when the circular is saying doesn't apply for exports.
Venu sir, is it possible that recipient is outside India and place of supply can still be India?
Hello.
Yes.
Audible?
Yes, sir. Yes, sir.
Okay. I think the question of yours is, first of all, is it an export of service or not? Correct?
I feel it is an export of service. Okay, unless now Deepak has raised, will the place of supply for it to be in India? With that, I don't think. But anyway, I'll recheck. But question is, why they have specifically inserted recipient in India in the notification 12/2024? So I was thinking that it is a trade-friendly measure, but I wanted to know anything that I'm missing.
Okay. I think, I mean, what I'm seeing is this international transactions. First of all, do they want to tax it? I am not clear about it. Okay.
Sir, supplier
What,
outside India, recipient in India is taxed. Like a parent company is giving guarantee to wholly owned subsidiary in India, is
correct.
fitting under this, and it will be an import of services and to be taxed.
Correct. So, in a scenario where it is not all taxable, why would they want this rule to be specified for that purpose? Hello?
So if no consideration is received, will it fulfill all the criteria for it to be called as export of services? Because the consideration has not been realized in convertible foreign currency.
I think, Venu, correct me if I am wrong. This within India was inserted later, right?
It just got
Yes, sir.
inserted like last notification a couple of weeks back.
Correct, yes, sir. It was inserted.
With a condition of, I mean, with the exception being added as to the ITC being fully eligible, correct?
Yes, yes, sir. Correct.
Yeah, the
So-
proviso also got added only now.
Yeah. Okay. So it came together. Okay. So what I am seeing is there is no question of this entire rule is made to overcome the concept of I mean, I am not seeing why they added that proviso here and again brought that 2% thing. Okay. Only in scenario, but in the case of international transaction being an export of service, this rule will not become operative at all. Being since they export, so therefore they don't want this rule to be applicable, right? Hello.
Yes, sir.
So
Why
it
it
is.
would become
You
operative,
are
sir?
bringing out a totally a different perspective. See, basically, why this provision is inserted. Let's keep it aside. But practically, when we see what we were following before this new sub-rule 2 came in, is what needs to be followed even after. So there's not going to be any change in the methodology of a process or procedure. So
Right.
they're only addressing the changes which they brought out, which got impacted, and they corrected that impact. Otherwise, what was going on, the circular also clarifies that the taxability of a transaction of a corporate guarantee was existing even before introduction of this rule, which means
Yes.
that whatever the practice for your export transaction which you are disclosing, not disclosing, would continue. Now your question, coming to your question, whether does it require a disclosure? I think the people who finalize the financial account should come out and say how that is reflected in our accounts. I mean, your financials, you show it as an export of service. The main challenge which is coming out is the receipt of consideration. The exception card out for that deemed supply would equally apply. So it is to be considered. Is what I am understanding in that scenario. I think that is also coming out at one more place in the recent circulars about that international borrowings between the parent company thing, where they have said even though no consideration is received, it is treated as whatever the exclusion. So accordingly, I feel that irrespective of the fact you disclose in your financials, no, not financial, your GST returns, I am not seeing any implication per se, and this is not going to change in any way what we were doing or what we are supposed to be doing in your GST return. When your question got answered, or you can just clarify whether my understanding of your question is correct.
So my fundamental question is, why has this been restricted only to recipient in India? So I was thinking that this is to give this is a trade-friendly measure, is what my view.
Okay. Now, how would it make difference if it is not made applicable to India transaction law?
So if it is, if assuming if that that wording is not there, even for transactions, I have to necessarily now add 1%, because the proviso says that if the recipient is eligible for input tax credit, the notional value. In case of an export of transaction, recipients are never eligible for credit. So mandatorily, I have to charge 1% even whether I have not collected or not. So which would create an issue for even GST kind of from the refunds perspective. Even in income tax, since it has been added, so the domestic transactions, they have to show so much of profits.
Now,
So
isn't it export of service? Where are you going to charge? Why are you going to charge?
Because the proviso says the recipient should get credit, only then no charge. Otherwise, it is a mandatory 1% charge.
No. It's a valuation provision, not a charging section.
Correct, sir. The valuation. So the circular says the levy exists.
Correct.
So the presumption is levy exists.
No,
It's a
levy
value.
exists, but it is relaxed by virtue of section 16 of IGST Act, no? Being export.
In 16, we don't have this relaxation for this.
No, there's not be specific, no? It's a general, any zero-rated supply. Will it not fulfill all the condition of zero-rated?
Correct, sir. So it is a zero-rated supply.
Correct.
So necessarily, I have to charge 1%.
Sorry?
Rajiv sir and Venu sir. Sorry to
please.
interrupt. Is it export of service? Because you, in consideration is not charged, you are not going to realize any money. So in the limb for export of service of realizing the consideration in convertible foreign currency is not fulfilled. When an Indian entity is providing corporate guarantee to its subsidiary located outside India, the recipient is located outside India, but you are not receiving any money. So can you still call it export of service just because the place of supply is outside India?
Okay. I think let others express their views. After that, I'll speak on that. I think somebody else also has raised this question, right, in the chat.
I have only raised the question. So, Bhuneshwar, your point is right. It is subject to receipt of the currency. Otherwise, the zero-rated benefit would go up. But what I'm trying to tell is, if this proviso, if this recipient in India is not brought in, then it has to be mandatorily be charged. And it will create hassles to the people. That's why I felt that this has become brought in as a trade-friendly measure. That is why I was saying that putting this point was necessary.
Okay. Bhuneshwar, my answer to your question is, when any time in the statute a deeming fiction is created, the deeming fiction has to be taken to its logical end and cannot be left halfway. Okay. So when there is no consideration, you're deeming something as a consideration, is said to be received and you're liable to pay tax. Obviously, that amount also in such a scenario, a consideration is to be considered to be as deemed to have been received. Hence, it has to be treated as export of service wherever the recipient is located outside India to fulfill other conditions. So that aspect of it, I am not, having any doubt on that. So it would still be considered as an export of service. Okay. Otherwise, coming to the next alternate thing, if that is not the scenario, this valuation subsection 2 being made not applicable would not take away the liability to pay tax on the said alleged exporter, because the general rule applies, though not this subsection 2, subrule 2, thereby they have to arrive at some valuation and pay tax. So merely by the fact that subrule 2 is introduced, having the transaction, recipient located in India, does not mean that others are excluded from the levy. Okay. So this also is clarified. As I was mentioning, one of the paragraph in that circular says the past transactions also is liable, but as per the valuation. But what is the valuation? The circular doesn't speak about it. So hence, there is a liability if we say so, but I am of the understanding that it's clearly an export of services in any deemed supply transaction between a related parties where the recipient is located outside, where the place of supply is located outside India. This is my clear understanding on this. I think there's one circular on this bank loan from the foreign country. I think Venu, can you just refer that circular and tell what does it? There's one paragraph on that also, right?
There also, sir, one of the things in that loan circular, it says Schedule 1 cannot just come into picture. Actually, I'll just pull it out. Just
Before
like that.
Rajesh sir, so you're saying that this will not, this sub-rule 28.2 will not apply for export, which means you're saying 28 will apply. Okay.
Yes.
To just stretch that, this insertion happened in July 24, right? So for transactions which we are giving a bank guarantee to a foreign subsidiary will apply prior to this then?
I think, if I'm not wrong, that they brought in retrospectivity to this rule, I think, no?
No, this is not retrospective. Retrospective from October 2023, not before that.
Yeah, that's exactly what I'm telling. So when they inserted
Prior
this
to
sub-rule,
October 23?
see, prior to October 23, your general rule applies. That is your 28.
Okay,
1.
correct. So even in case of export, you're saying there has to be a valuation,
Yes,
which is not defined.
which is not defined.
Okay.
Venu's question was, will it have my computation of a export value for the refund, my turnover, etc. I think I do not see any difference by adding sub-rule 2 in rule 28.
Sir, my point was, given that they didn't want to tax the export transactions, they have amended 28.2 and said only if recipient in India. So they didn't want to make this mandatory application to people outside India.
Okay. I think there was some background to it. Let me just see that background and revert back. Meanwhile, others can take the further other points and discuss. I'll address this. Just give me a couple of minutes.
Yeah, Venu sir, in subsection 2, by excluding person recipient located outside India, whether they are making any changes, because if it is not sub-rule 2, any more sub-rule 1 will apply.
So this would become a specific provision, my lord, my view. So since 28.2 is specifically talking about corporate guarantees, so I will not go to 28.1, and I would say I would only be fitting to 28.1. I get your point. Then why not 28.1? But my take on it is I will not go there.
No, sir, see, 28.1 is the general, 28.2 is specific. If I am not falling under specific, I have to fall under general and get complaint, right? But
Okay,
by
that
doing
being
it,
the case, what is the purpose is achieved by mentioning specifically the recipient being in India? Why should at all that be mentioned?
In India, they want at least 1% GST because it is comes RCM. If it is 28.1, the valuation they may take 1.1%, 0.5%, whatever they may take. But they want to ensure that import of service minimum they want 1%. Maybe that.
Dhanesh, now you have to.
So 1% comes in from the from what I understand, 1.5% to 1% is what generally the banks charge, and that is where the safe harbor rules also said that it would be somewhere between 0.5 to 1%, and I think our GST law is taking in from there. That's what I understand theoretically, but practically, Jatin sir, Rajesh sir can tell us what happens. 1% is what I understand. Generally, also banks charge that much, and that is where the that's what has been picked for the valuation purpose.
Tanushree, I have some basic questions.
Huh.
See, you started with some OECD guidelines, right?
Hmm.
There, like, even in transfer pricing, we have something called as a letter of comfort, how to value the corporate guarantee and all that. So
Yes.
why are we looking at, in GST perspective, like, why are we not looking at the whole transaction in a holistic manner? For transfer pricing, okay, there is a different mechanism. For GST, okay, prior to 2017, applicable, service tax was not applicable. From 1st of July to whatever so-and-so period, I think till October, it was considered as, deemed value, section 771C, all that. Now we are coming out with rule 28.2 and there is a circular. Why are we not able to look at it holistically? Why can't we say that, yes, if it is a corporate guarantee, there is something called as letter of comfort where this certain category of transaction will not fall under wherever there is no consideration, it will not be subjected to GST. There won't be any levy of GST. There are certain transactions, if so and so category, if it fulfills conditions, if it fulfills, it will GST would be applicable. So can't we borrow those things, whatever you started with, OECD guidelines is what you started with, right? So can't we borrow the same principles here also? Or are we trying to do only that? Or we are discussing, are we we are interpreting the law how it has to be or something like that, or our understanding is wrong? Internationally, how does it work?
So we are borrowing the same principles.
Okay.
The definition of corporate guarantee in income tax and GST, or in fact, even generally, is the same principle. Just that in income tax or whatever with the principles that I borrowed, from what I understand, letter of comfort, shareholder activity, etc., are not corporate guarantee. There has to be explicit corporate guarantee, a document saying this is a corporate guarantee and this is the amount for which I am guaranteeing. That should be the document, is what I understand, and that's the same across. So it is a holistic view only. There's nothing different that I'm trying to say for income tax as well as GST. I borrowed income tax just to say that corporate guarantee was not considered as international taxation, international transaction earlier. And once the definition came in and once the explanation came in, it has been considered as international transaction. And why it has been considered as an international transaction is what Reddington case law said, that because there is a risk, though it is not affecting the profit, etc., immediately, there is a risk that the guarantor assumes, and that is where the guarantor provides a service. And the same principle I have derived under, I borrowed for GST as well, that there is a service wherever there is a guarantee, because there is a risk that has been assumed.
So basis on that, can't we simplify this? Is that what my question? See, prior to GST, forget it, no GST. From 17 to this period, deemed separate. From this, can't we make it simplified?
It is, I don't understand.
Why are we saying that even there is no consideration, there is GST applicability? Why is it not looked at it in a harmonious way? When the things are settled in transfer pricing, I'm assuming that it is settled. When things are very clear, settled, the principles are already laid down, why are we not borrowing or setting that as a fundamental principles and going ahead in GST? Is that what my question?
Okay. Madam Sridham, I'll answer your questions.
Yes, sir.
Okay. Before that, I would like to address Venu's question, why that in India concept. Venu, I was just going through the background for it. The point is not in cases where nothing is charged, in cases where some amount is charged. Say, I charge to my foreign subsidiary 0.75% or 1%, not 1%, 0.5%, something which I charge, where it is not a case of not charging anything. So if they're creating a deeming fiction of 1%, I do not receive that the differential value. There's a 0.5%. So there was a concern expressed by certain companies saying that that will be effectively it become taxable, because to that extent I have not received a consideration, though the value is there. So they said the intention was never to do that. Hence, to bring in a clarity aspect of it, this is only confining this 1% valuation to only to domestic transaction, not for international transaction, where the condition of receipt of money in convertible foreign exchange for the value you are supposed to have charged is coming to picture. I think that is a background with which this in India has been added.
Right, exactly, sir. So my point is, what if at all I haven't even charged anything? Even
No,
that should be fine.
No, I'm telling that scenario, anyway, there's your deemed valuation is covered, no, in that consideration part of it.
That is applicable only if recipient is eligible for input tax credit. So in
No,
the
not
current
in the
case,
valuation, I'm telling when completely deeming fiction, see that there is no necessity as such that have been covered, but to bring in a clarity they have written. But my understanding of the law is, once there is no value charge, but the law is creating some deeming fiction, it has to be assumed that that has been received. So there is no need of a physical receipt of the money in case of a foreign transaction where there is a deemed consideration created by the statute.
got it. So
This
my
is-
point is, if no consideration is charged, should
Correct.
at all be 28(1) be applicable or be silent?
Sorry.
If the Indian parent has not charged any consideration to the foreign
Your
subsidiary,
28 is applicable.
and I don't know the value,
That
open market
is
value, I don't know.
that is a headache which we have been facing even before introduction of this rule. The same thing will be applicable now also. You adopt whatever the value you want to adopt, applying that set of rules, which nobody knows what is it. Okay. Coming back to Sujata Madam's question, Madam, we are dealing with this because the provisions of the income tax and the purpose of income tax law is different. And as it is the law, even there was one issue under the rest law where they said that consideration is required because that was an essential thing. But the changes or the change scenario in the GST law is there's a deeming fiction which is created where the consideration is not required for a transaction between the related parties. That is where all this problem is arising, and the government is clear that they want to collect tax. In fact, before all these things, I think earlier couple of our discussions on the corporate guarantee, we did have a reference to the Contract Act and said that who is a borrower, who is a service recipient. I think Dhanashree appears to have not touched that aspect of it. Probably if Jatin sir was there, he would have gone on that more essentially. Saying that what is the corporate guarantee or a guarantee under the contract law, whether it creates a supply at all is a fundamental question. I think in a litigation we have to take. But since the council has discussed, everybody is talking and evaluation is coming, rule is coming in. So always the tendency is, the understanding of the government is clear that it is a liable for tax. So radical thought process that it is not at all supply would definitely lead to litigation. So rather than taking that as a standpoint for the future transaction, probably we might have to take the stand for a past transaction. Again, the circular at this one point says that this levy was all along there, so only a valuation. So that null is fine. There are two aspects I want to emphasize. For there can be a notices for the past on the same aspect of it. Referring to the circular, up to March 20, extent period of limitation, that 74 cannot be invoked based on that the time limit is already lapsed. And my suggestion would be to keep contesting that issue. So, in a near future, there may be a representation by the various trade industry, and they may give a clarification under the new section 11A, notification 11A, where they may give a relaxation for the past transaction. This is what is my input on this topic. Anything else? Any questions we can discuss?
Rajesh, morning. Idinille.
Oh, ಇಲ್ಲಿ ನೀವು ಇದ್ರೆ ಸರ್ ನಾವು ಮಿಸ್ ಮಾಡ್ಕೊತಾ ಇದ್ವಿ.
ಅದು ಸ್ವಲ್ಪ ಲೇಟ್ ಆಯ್ತು.
ಸರ್ We want your input on this
See-
guarantee from the contract act.
See, there are 2-3 other questions related to this that I just want to touch upon. ಈ questions ಎಲ್ಲ ಮೈಲಾರು ಸುಜಾತಾ ಮೇಡಮ್ ಎಲ್ಲ ಪಾಯಿಂಟ್ಸ್ ಎಲ್ಲ ರೇಸ್ ಮಾಡೋದು. See, first of all, supply has to come first, then valuation. Just because there is a valuation provision does not mean supply can be assumed. Now, if you see sub-rule 2, Venu sir, it talks about notwithstanding anything contained in sub-rule 1, where? So it talks about the situation when sub-rule 2 will come into the picture. There are 2 requirements for sub-rule 2 to come into the picture. The supply should be by a person where the recipient is located in India. Okay, na? You understand? The recipient who is related. Venu, idiyani matra, notwithstanding anything contained in sub-rule 1, the value of supply of services by a supplier to a recipient who is a related person. So there is a subset of the superset which is covered by sub-rule 2. That means anything that is outside the subset will still remain within the superset. And which is a subset? The recipient is in India. By way of providing corporate guarantee to a banker on behalf of the said recipient. Now you please visualize how many situations the guarantee is given on behalf of a recipient. I can think of 2 situations. The subsidiary is not entitled to loan. Subsidiary is not entitled to loan because it has no track record. It is an SPV. The lender says, look, I don't know who this subsidiary is other than the name that he has. Therefore, I will not give the loan to the subsidiary. In such a case, the parent company steps in and gives guarantee to the banker to advance money to the subsidiary. This is scenario A. Scenario B, the subsidiary is fully entitled to the loan. Subsidiary is having assets of 100 rupees. They are borrowing 70 rupees, which means already the banker is having 30 rupees margin. They now want the parent company to give a corporate guarantee. This is scenario B. In scenario B, why will the banker ask for a corporate guarantee? You tell me. Loan is 70 rupees, margin is 30 rupees. What for he wants a corporate guarantee? If the corporate guarantee is equal to another 70%, then you know what it will amount to? It will amount to more than 100% of the loan as margin. The purpose of this corporate guarantee is not that the loan is doubtful. The purpose of this loan, this corporate guarantee, is to prohibit the parent company from preventing the subsidiary in honoring its terms of borrowing. See, the control that the parent company exercises over the subsidiary is so substantial that even if the subsidiary is willing, parent company may take certain decisions that impairs the subsidiary's capacity to fulfill the terms of borrowing. So therefore, they execute a corporate guarantee. So there are 2 scenarios: SPV having credit. Second, scenario A, SPV not having any credit. Scenario B, SPV having sufficient credit. Now we will read the language of 28(2). By way of providing corporate guarantee to any banking company on behalf of the recipient. Please see the words "on behalf of" has been the bone of contention in intermediary services. And board has issued a circular to say that if it is on own account, it is not on behalf of. But if it is not on own account, then only it is on behalf of. So if you see, it is on own account, scenario A, where SPV has no credit, the parent company is actually the principal borrower. When SPV has no credibility to borrow money, the way you want to write your contract, you write your contract tripartite. But the principal borrower is the parent company in scenario A. When SPV has no credibility, there is no supply. So therefore, Rule 28.2 has no application. Scenario B, where SPV has sufficient credibility to borrow money, again there is no supply because the so-called corporate guarantee is only on own account, so that the parent company is a co-obligor and not a co-borrower. You understand? So when you visualize scenario A and B, unless we come up with a third scenario. What is the third scenario? I will tell you, scenario number C. There are certain reasons that the margin is considered not sufficient to extend the loan. For example, the subsidiary is setting up a plant and those assets are given as collateral, but the plant itself is not secure. For example, the plant is the oil rig in high seas. You are sending a rocket to space. If the lender feels that his security may get destroyed and mere insurance is not sufficient. So can you visualize, out of the total population of transactions where corporate guarantees are given very commonly, a very small subset of those transactions fit within the language of 28.2. But today what is being done is, very mindlessly, department says whenever there is a CG, you have to pay tax on the valuation under 28.2. Third situation is, tomorrow if somebody pays tax, but a court says it is not payable, now you please see the whole of both the circulars. 204 also you see, and you see this one also. 225 also. Department can easily explain itself away, saying that I never said all CG transactions are covered in 225. I only said such of those transactions that cover within 28.2 only has to be dealt with in accordance with Circular 225. Who told taxpayers to make this assumption that all transactions are covered by 225? Therefore, within limitation, I will give back the money, but otherwise I will not give back the money. Next situation to consider is, wherever full ITC is available, 0 is also sufficient. Correct now? Whatever you declare will be the value. 1% will be the value. Otherwise, whatever you declare will be the value. Now, you please see, we are assuming there is going to be a supply. Now, who are the people who will pay tax on corporate guarantee? Wherever they can get ITC, they are indifferent to it basically. Anyway, I have net tax in cash. Whose battle am I fighting? I'll just pay this net tax cash amount under 3.1D and finish this headache. Why do I want to help in development of the law? Who are the people who are going to fight it? People who are going to fight this are the people who are not going to be eligible for credit. That is renewable energy power plant fellows and residential real estate fellows. So now you visualize a very substantial portion of the tax-paying public has been reduced to a very small population of people who are interested to fight this case. Therefore, we are proceeding on the presumption that giving of corporate guarantee is a supply. You remove corporate guarantee and you take goods or services. Can you imagine tooth and nail we fight to say that it is a supply, it is not a supply? GST is a tax on supply, not a tax on benefits. And this is the part that Rajesh has told me to discuss. If you see section 127 of contract law, consideration to surety flows from lender agreeing to extend facility to borrower. Now, if you see, surety and lender are unrelated parties. Borrower does not have to request the surety to extend the surety. You understand? Borrower will only go and ask the lender to lend money. The lender needs to direct the surety to stand guarantee for a private contract between the lender and the borrower. It is very important for us to study the recitals in a corporate guarantee contract. Whereas so and so lender, borrower has been appraised of their creditworthiness and it is found that they are not eligible for credit. Whereas the borrower approached the lender for 100 crores loan, whereas the lender declined to extend the facility, whereas borrower approached the surety and said, based on your credibility, lender is willing to extend facility, whereas lender further did appraisal of the credibility of the surety and came to conclusion that surety has sufficient credit net worth to stand guarantee. Whereas at the request of the borrower, the surety extended guarantee and lender agreed to enter into a loan agreement with the borrower dated so and so, which is annexed as appendix number A. This is the structure of the agreement that will fall within the scope of 28(2). You know, there are many instances where private money lenders also give guarantee. Money lenders also give guarantee for a fee. Now you have to see whether the surety is the principal borrower, then it is not. It is called a corporate guarantee contract, but it is not a corporate guarantee contract. Because if the surety is the principal obligor, then the surety is the borrower. Financial statements may carry the loan in the books of the SPV or in the books of the parent company, because financial statements are prepared based on substance of the transaction over the form of the transaction. GST operates exactly on the opposite. The form of the transaction should prevail over the substance of the transaction. Only one example I will give you. Please bear with me. Under Ind AS 116, the lessor will account the asset given on lease at historical cost. The lessee will also account the asset in his balance sheet at NPV of future lease payments. Is it possible that the same asset is capitalized in the books of two entities? That is the beauty of accounts. So let us not outsource our identification of the ingredients of supply to some damn balance sheet which some damn auditor has written. Let us apply our own mind to find out what the heck is this supply all about. And if contract law says the supply, the consideration to the surety flows from the lender, there cannot be two pathways for consideration to flow, one from the surety, one from the lender, and one from the borrower. 28(2) is being implemented to convert GST from a tax on supply to something like a fringe benefits tax. If you start looking for benefits, there will always be benefits to various persons arising from a transaction between two separate persons. The school and the parents enter into a contract and the child gets education. The donor will give money to the food supplier, and some poor people who get food and clothing from them will get all the benefits. Then CSR projects. If you start looking and start taxing benefits, there is no end to this. So if you identify, the last point I'll mention and leave it for questions if there is any. Why will a surety stand surety for a loan between the lender and the borrower? Please keep in mind, there is what is called the right of subrogation. The parent company has an obligation to inject equity into the subsidiary company. The parent company, if they don't inject equity into the subsidiary, they will be in default. Now, the parent company decides to do better cash management, and instead of parting with liquid cash, they decide to leverage their idle assets, securitizing the assets and extend loan from the lender to the borrower, because cost of capital is now a deductible expenditure in the SPV's hands. But cost of capital in the parent company's hands is not deductible, it becomes dividend. So there are various motivations for doing this. There are various motivations for doing this. Unless we can expose the small subset of transactions where I told you the sequence of events in the recitals of a corporate guarantee agreement. If that sequence is absent, there is no supply. Benefit is there or not there, that is not relevant. There can be no tax simply because valuation provisions are there. I'll pause here.
So now that it has become more like, more and more you tell the lie as truth, the lie, I mean, more and many number of times you start telling the lies, it becomes a truth. It has become like that. So initially when I was allotted this topic, personal guarantee of directors, there I dealt with the section 126 and 127, what you explain now. That point of time, we concluded that there was, unless and until there is a supply, GST, I mean, on this corporate guarantee is not applicable. But now, after reading so many, circulars and other stuff, it also creates a confusion whether should we take that stand, or whatever you said, we can take that as a, principles are very strong. So on corporate guarantee, GST is not applicable unless and until the consideration flows from to the principal debtor, or from the, the borrower to the surety. So how to go about, sir? Like, what is the general principle, sir?
You have to decide whether you want to pay or you don't want to pay.
Mm.
If you want to pay, there is no client. If you don't want to pay, there is client. When you don't want to pay, that is where the whole discussion will arise. If someone wants to pay, you can't stop a stupid person. And there are a lot of domestic stupid people, MNC stupid people who don't have the motivation to litigate. Why are we litigating 2A, 3B issues? Because somewhere we feel cheated. I anyway purchased it, I anyway did this. In spite of Ecom Gill, we are saying that we want to litigate 2A, 3B. But corporate guarantee, without reading contract law, without reading GST law, people sit and think in boardrooms. I think there is some benefit, no? Maybe there is better pay 1%. What if tomorrow they say 5%? Now those buggers have said 5% also if you give the corporate. How can you give corporate guarantee 5 times if it is 5-year contract? Your supply is only once. You cannot increase the valuation just because it is a longer duration contract. So 3-year contract is 3%, 10-year contract is 10%. So visualize it from that point of view. And our response as students of this law should not be to give in to this confusion, so-called. If confusion is there, that means there is still hope for us in practice. But in our own minds, is there any ambiguity about whether there is supply? And if there is supply, which is the small subset of transaction where such supply will take place? Sujata madam, question for you.
Yes. That's what, sir.
No confusion. Confusion namak vanda.
No, sir. It's not all about confusion. But more and more we say, oh no, it's a deemed supply. Then there is a 28.2. Then there is a circular. So we are even lost. Okay, no, let us forget about whatever we understood. This is what it is going to be. So because unless and until we have some real case to fight, we have to go by the circulars and what is there in the provision of law. So we go by that. But we cannot keep on saying, this is how it has to be. Ultimately, we have to read the law and understand and follow.
I'll give you an example.
So
Madam, I'll give you an example. There is a company that goes to a bank to borrow money based on a term loan for its machinery purchase. They default on the loan, and the bank takes away the machinery and auctions the machinery.
Yes, sir.
Now, taking transfer of title from the borrower to the lender, is it a taxable supply?
against the loan, it has taken over. So as far as the company is concerned, it has sold the machine. No, against the loan, it is also,
You are
sir.
no, you are changing the facts. This is not a, see, what is a sale? Sale is a contract. What is a contract? Contract requires free consent. There is no free consent here.
Correct.
This is inevitably, he has come and taken, he's exercised his right as a lender and taken over the asset. It is not a sale. The supply has only 8 forms of supply, and this does not fit within the 8 forms of supply. Then there is no tax. Correct,
Yes,
no?
sir. Yes, sir.
There is no
Yes, sir.
tax, so therefore no ITC to the lender. But when the lender auctions it, that is a sales impliciter. So there is output tax. You understand?
Yes, sir.
So just because in substance a transaction resembles a sale does not mean we will clothe all such transactions with the ingredients of a taxable supply and happily pay tax. We will look for missing ingredients. If the necessary ingredients are missing, then we will still not pay tax. Similarly, the small subset, this question now is for Venu. Venu, do you agree that there is only a small subset of transaction that is captured in 28.2? And question for Mylar is, if the superset itself is not a supply, it does not even come within 28 itself.
Sir, I agree the concept of the subset. I get that.
But that is not for a trade-friendly measure or any such thing for us to start furnishing the missing logic. Law is what law does. If we satisfy ourselves by giving some reasoning for such introduction of such a rule, then by implication it will be what you are saying regarding export. If it is a transaction that fits, it should cover exports also. Why should it not cover exports? It should give, like Rajesh was rightly saying, it should be given full extent of implication. Mylar, if it does not fit the subset, will the superset cover the universe, or it will only cover those transactions which are only supply to begin
Only
with?
supply, sir. Only supply, sir. I like this.
So therefore, when the entire transaction is fictional, Bhuvneshwari madam, if the entire transaction is fictional, how can you defeat this transaction based on payment criteria? Can you give me 2-3 examples in the law where payment criteria has been excused, which is not in the statute?
For Rule 37,
Exactly.
reversal of input
Yeah,
tax.
exactly.
There
One
is
more
a
example.
specific provision.
Exactly. It is there in the rule, not in the statute, no?
Yes.
Very good. Next, one more example you give me. In FAQ for REP, RREP, they said for that transaction between developer and landowner, there is no need for cash consider. There is no need for payment criteria. So what Rajesh is saying, I agree that the principle is that if it is a deemed supply, don't introduce a rule that is not meant to cover a transaction like this. On one hand, it is non-monetary. On other hand, you're introducing a rule that never applies. We had this point of taxation provision where the words used were only whether the payment is made. Department started to levy tax on joint development agreement saying, look, the consideration in non-monetary form is already received prior to 1717, so you have to pay service tax. Since the word payment is used, payment cannot be used for non-monetary. Payment has to be for monetary. So when the payment criteria is there, the criteria does not apply. And we have enough examples in other context to say that going into this question is not relevant. So therefore, madam, do you feel if it is 0 rated, it will not be denied 0 rating benefit because of payment criteria?
Okay, sir.
See, this is where my concern is that when we are being guided by the circulars and the rules without drawing the source of our understanding of law from the statute. It is easily possible tomorrow when it is challenged for the government to say the rule is there only subject to the act covering the transaction. Who asked you to assume the rule covers the universe of transactions? And we have seen this in 2 instances very recently. Department started levying tax on shareholding transaction because there is an entry in the tariff. How many of us paid tax? But why are we happy to pay tax on corporate guarantee? Although there is an entry that looks like it can cover shareholding transactions, the underlying transaction is not a supply. Now there is a board circular. We have instances like this, several instances like this, where circular clarifies a certain situation. Like discounts, we said, intermediary, we are disputing. In all these transactions, they are giving multiple circulars to clarify circulars. Please don't outsource your understanding of interpretation to a damn circular. Shamelessly, they are withdrawing circulars without giving the explanation. Shamelessly, they are distancing themselves from circulars without saying why the circular will not apply in a particular context. So therefore, if a circular aligns with your understanding, then rely on it and cite it so that there is no dispute with department. But if your understanding does not align with the circular, find something in the circular that leaves room for such transactions to escape out of the language of the circular. Circular is like a net. If the size of the transaction is larger than the spaces that it allows, then those transactions must be let to escape. But only such of those transactions that are larger than the size of the holes in the net that will fit within the terms of that circular. Okay.
Sir, I have a basic question actually. So in terms of corporate guarantee, there is a, like you said, a surety, then there's a borrower and the lender, right? So the surety will give a guarantee to the bank and the lender gets the loan. In this case, from what I understand, practically whatever the bank charges fees to the surety is cross-charged to the lender. In such a case, it would become a service?
Madam, there is the fees charged by the lender to the surety is not for accepting the surety. The fees charged, so therefore that is not the consideration. Suppose we take housing loan. I take a housing loan, 1 crore rupee, and the processing charges is 5,000 rupees. Is 5,000 rupees the consideration for 1 crore loan? No. 5,000 rupees is for stamp paper, coordination charges, etc. So that is nothing to do with this. Whether they decide to cross-charge, they decide not to cross-charge, they decide to absorb it. How many instances lenders decide to absorb the cost of processing? So therefore, that is not consideration under 28(2). That is a separate transaction of processing charges, whether they, on that will anyway be liable to GST, whether they cross-charge or if they decide to absorb it, they will absorb it.
Not the bank, sir. Like the surety will cross-charge it to...
Surety need not cross-charge, no? Because if the surety is issuing the guarantee on behalf of the borrower, then he will say, look, everything that is incurred on this, I'm going to recover from you. But if I am a joint venture subsidiary, I'm not a wholly owned subsidiary, I will say, look, injecting equity was your problem. You bear all your costs. You don't pass on those costs to me. You want to give me equity, that I will allow, but I will not accept all these charges because treasury management is your decision, not my request.
The other thing, sir, the High Court, Bangalore High Court and Delhi High Court had given a stay. Say one of the councillors argued that the provision of corporate guarantee is in the nature of contingent contract, not enforceable till the guarantee is enforced.
This is Raghuram sir's matter, no?
I think so, sir.
No, Rajesh
KSW
matter was different. No, I think the lead was by Raghuram sir. I don't know do you know the details of the case?
It is, no, sir, it was actually only a stay order.
Yeah.
So
So
couldn't get the background fully.
I think the lead was by Raghuram sir, where the
Okay.
argument that was considered was that it is contingent, etc. But please consider the grounds that is advanced to get through the doors of the High Court has nothing to do with the ultimate decision.
Correct. Yes.
To show maintainability, there must be a prima facie case made out by the council. So
Hmm.
don't think that Raghuram sir will actually argue on contingent contracts.
Hmm.
There is no contingent contract. There is a contingency which is the subject matter of the contract.
Hmm.
Tomorrow we will say insurance is contingent contract. Insurance is a contract of assurance of the happening or not happening of that contingency. You understand? Motor vehicle insurance is not a contingent contract, it's a special contract. So there is a contingency which is a subject matter of a corporate guarantee contract.
Hmm.
Contingent contract is what? Only if you pass your final exam, you will get a job. So today, this contract has a contingency linked to the commencement of the contract itself. So I don't think it's a contingent contract. It's a contract covering the contingency.
Hmm. Okay, got it. Yes, sir.
That's why stay order ಓದ್ಬಿಟ್ಟು ಸಂತೋಷ ಪಡಬೇಡ stay order ಎಲ್ಲ stupid ಆಗಿರುತ್ತೆ.
Sir, how do is there a possibility for us to get more background on the stay order, sir? Because the stay orders are like very small one-pagers.
ಇಲ್ಲ, you can get a copy, full petition you can get a copy.
Okay.
Ask Banu, he will only send, or you can get it from court if you don't know the council.
Okay.
Ask Banu, Raghavendra, you can get a copy. I'm sure sir will be happy to share it with us if you are taking it to study. Or from court you can get it.
Okay. Thank you, sir.
Okay.
Any other?
Sir.
Yes, sir. Dhanashree, from the questions that are there, anything?
Sir, I have one more actually question. This corporate guarantee has been there for a long time, but there haven't been any substantial matter in terms of High Court or Supreme Court arguing whether it is a supply, not supply, and what are the what is the background of this and things like that, no, sir?
You're right. See, there have been a lot of decisions in the context of contract law, insurance law, etc., relating to corporate guarantee. But in GST, it's only now coming up. You're
Even
helping
in service tax law, sir.
See, in service tax law, all this deemed business was all very limited.
Correct.
So therefore, it's something that's going to start. Service tax law started this intermediary business in a big way. So these are all interesting times ahead for young practitioners.
Thank you,
It's
sir.
not like everything is done and dusted and now only comply with the settled law. Now the dust is rising.
Yeah, this is actually inspiring, sir, because like a lot of things that we look at is just like surface level. Even the notices that we are handling,
I tell you,
surface level.
You're absolutely right. I tell you, this is like the 50s when the constitution came about, 50s and 60s. If you read the book of the Courtroom Genius of Palkiwala, it talks about how Palkiwala was there at the right time when income tax law was taking shape. Everyone knows him as a constitutional law lawyer, but he has made some significant contribution in the development of income tax law. So it is something like that for young practitioners. If anybody thinks that they are, we only have to fill forms, update tables, and then get by in our career in indirect taxes, that's completely wrong. You will see things unfold and get settled as law. So therefore, interesting times, which is why all the more reason not to outsource our thinking to circulars.
Yes. Also, would you recommend something more to understand corporate guarantee, sir? Like Contract Act is just the law, but would there be something more on corporate guarantee itself, like the types of guarantee, what is it, and all of that?
I don't know if there is one book that addresses this topic in a very detailed manner. I would only advise you to please see if it's possible to get hands on 5 corporate guarantee contracts and read how that contract really says and what does it place each party. I mean, so many of us do real estate related GST work. How many of us have read a JDA? How many of us have read a supplement to a JDA? So like that, read the contracts, take 5 varieties. I'm sure some law firm or the other we know who will have drafts of this or executed copies. Just take a look at those and then read. It will sort of open up the nature of relations inter, say, lender, surety, borrower, for us to truly appreciate whether at all this is a transaction that comes within the subset of 28(2).
Yes, so makes sense. Thank you so much, sir.
Thank you.
So would you have like some of the one or couple of the contracts or something like that, sir?
Yeah. I'll try and share
Okay.
maybe.
So then I'll get in touch with you, sir.
Yeah.
Thank you, sir.
Madam, in this whole discussion, I think we have missed the fundamentals. Because I'm attending from the beginning. Now, this whole corporate guarantee. Now, who is the supplier of service? Who is the recipient of service? Actually, there are 3 parties involved in a corporate guarantee. And invariably, it is always a transaction between related parties. Because otherwise, it's difficult. I mean, practically, it doesn't work. Now, fundamentally, who is the supplier of service? Who is the recipient of service? The surety is given to a bank, but here the liability is passed on to the recipient. So I think there is a little maze of confusion here. First of all, whether the whole thing is a supply or not a supply. Only if it is a supply, then further valuation, further payment of taxes, further taking the credit, etc., etc. Now, the fundamental issue I think that has not been addressed is who is the supplier, who is the recipient.
Yes, Vijay, agree. Like that's what Jatin sir was also pointing out, that we should first question the supply itself. I thought by reading some of these income tax related thing, I figured maybe it is a supply, but there is more to it. I think I will go through some of the contracts that Jatin sir is sharing, and maybe we can rediscuss this for some more time. Jatin sir has already touched upon some of the things. So right of subrogation in terms of how Contract Act is framed around this, all of that. So let me also go through that, and maybe we can discuss this again.
Any other points, anyone? Jatin sir, I think, see, the fundamentally where the difference between taking corporate guarantee as applicable to GST is, as you rightly said, the benefit. Somewhere in the mind, it is clear that the recipient is subsidiary, given that the holding company has given the guarantee, because of which the loan has been sanctioned. So there is an supply underlying. Because of that, because of this, people have taken it as a position saying that the GST is applicable. It is little difficult to distinguish the benefit versus the service. I think that needs more reading and more maturity to say that not every benefit is a supply. Like at your stage, you can talk authoritatively, but yeah, I think it needs more reading for us to say, yes, it is a benefit, but not a supply.
Brenda, let me just add here. I don't think we should sort of discount young people's capability to understand these transactions. It's just that we have sort of gone with the flow based on the words corporate guarantee being thrown into the rule and the circular.
Yeah.
We take an example. I'm sure I'll give 2 examples. There is a charitable institution registered under 12AA that provides clothes to poor children. And all members of the study group, Bangalore study group, are asked to contribute 1,000 rupees each. Now today we are gathered here today. So all of us will contribute 1,000 rupees each, and this 12AA institution collects the 1,000 rupees. Let us say 20 people are there, 20,000 rupees, and it will go and purchase the sweaters and give it to poor children. Now, can we say that the charitable institution is doing the charitable work, or the donor is doing the charitable work, and the charitable institution is an event manager, so-called, facilitating the distribution of sweaters to poor children by the donors? Ultimately, donation comes from the money that the donors give, not from the agency of the charitable institution who can connect the donor with the beneficiary.
Right.
We have to look at the form of the transaction. Donor gives money to the institution. Money comes into bank account. Transaction concluded. Although institution has explained to the donor what they will do with the money, etc., is not relevant at this stage. It is relevant only to receive the money. Afterwards, the institution goes to the market, purchases sweaters, and receives a bill with GST. That transaction also completed. Now the institution has a stock of sweaters. Inward supply, they have accounted it. Where is the outward supply? There is no outward supply recorded in the transaction, because this giving away of sweaters by the institution to the poor children is not a supply. It is a depletion of inventory. What is the P&L looking like? Donation received 20,000 rupees, sweater purchase 20,000 rupees. But both are not connected transactions. So therefore, we have to examine whether the benefit is being taxed or the supply is being taxed. The supply is taking place by the sweater supplier to the institution. Whether it is for donation or own use or redistribution, the supplier does not care. So there is tax on supply of sweater from the market to the institution. Funds generated are separate. Handing over of the inventory to somebody else is to the beneficiary is a separate transaction. Like that, we will need to break up the transaction, and there will be no confusion. If tomorrow, now take an example, department comes and says the donor, the transaction between the institution and the beneficiary is liable to tax because you are related persons. Then what you'll do? We will argue saying that, look, giving away of sweater to related or unrelated persons is not a supply. Where is the question of valuation? The second line of argument will be, when I purchased it itself, I paid the GST. So where is the question of paying GST once again? Third argument is, the GST which I paid on purchase, I have not taken ITC. Therefore, where further reason exists to pay the GST. But if you see 17.5 FA, it says goods used in the provision of CSR activity. I am not using the sweater to do CSR. If I use a bus to transport poor people, that is using the goods for CSR. Here it is giving away of the goods. Is it covering within 17.5 FA? No. So our minds contains various theories about supply. In charitable, this is sweater example, our mind is more readily able to accept the absence of supply. Although we know what is benefit. Who is, suppose that all the children who are receiving clothes are all related family members. Then also you will see that there is no confusion in our mind. But somehow in corporate guarantee, again, this is a point that Vijay sir touched. The taxable transaction is the receiving of benefit by the subsidiary which is traceable to the surety given by the related party. This is the transaction, not the corporate guarantee itself, but the byproduct of giving the corporate guarantee. Next example to suggest is, when the seller sells the goods, the benefit to the seller is twofold. One is to receive money. In fact, for the seller, the bigger benefit is clearing of outdated stocks. That is the logic of giving discount, no?
Correct.
GST law very happily accepts discount, as if GST law understands discount very cleverly, but actually basics of costing tell us that holding inventory is only increasing cost than clearing inventory. So the sale price realized is net of the benefit of clearing the stock. So if you go into economic value added, etc., That is not what GST is all about. It is the price of the transaction, and the short point of price is covered in 15(1). We have tried our experiment with notional value for 40 years and failed in central excise. Normal transaction value. Finally, we came down to price. Customs also, there's a lot of experiment that finally came to price eventually when we had the new rules in 2007. So therefore, the benefit taxation is not the scope of supply. The supply is what should be taxed, and supply is guided by the form of the transaction and not the substance.
Understood. Any other points for anyone to discuss? All right. So we will conclude for the day, and definitely bad on my part for missing last Tuesday and sending in the last minute. I'll make sure by Sunday I'll send out the agenda and the meeting minutes, meeting calendar to everyone going forward. Yeah. Thank you, everyone, and good day. Let's meet in the next session. Thank you, Jatin sir, and thank you, Rajesh sir, for your insights. And thank you, Manishi. Yeah.
Thank you, sir.
Thanks. Thank you.
Thank
you all.
Thank you, everybody. Thank you.